चेक। हाँ जी दोस्तों, क्या हाल है, क्या हाल है, क्या हाल है। आई होप यू आर ऑल डूइंग रियली रियली वेल। दोस्तों, welcome to this amazing session of your GOAT revision. Yes, you heard it right. Sir, what is GOAT revision? GOAT is a revision basically brought to you by Shrestha Academy, wherein we are going to revise each and every subject chapter wise in a very organized manner. Okay. Before I start this revision, I'll tell you three things that you need to listen to me. Number one, sir, this is a chapter wise revision. You can get the full playlist in my channel, that is Shubham Singhal or Harsha sir's channel. In both the channel, you can get full playlist for law, wherein you can see these GOAT revisions. Number two, along with these revisions, you might need my books. The books, you might need my books, so you can purchase the books from shubhamsinghal.com or Shrestha Academy. You can purchase the books for just 700 rupees, and I promise you that is going to be the best investment that you make till date for your CA intermediate. Okay. And the third thing that I want to tell you is, along with the revision sessions, you are supposed to solve the question bank. Along with the revision sessions, you are supposed to solve the question banks. So if you look at my question bank, I have fully color coded it and all the keywords are highlighted in red. So it will be very easy for you to prepare from this notes. All right. I hope this is helpful for you. So today we are doing share capital part 2. Share capital part 2. We had finished until section number 59 yesterday. From today we are going to move to bigger and better sections. Today we are going to move to bigger and better sections. Are you with me? Yes, sir. While revising these sections, I'm going to use some notes that we made in the class. Some notes that we made in the class. If you want, you can pause the video and you can make those same notes by looking at my screen, because in your handwriting, it becomes very easy to read. What the handwriting that you have used in the classroom, that becomes very easy to read. Okay. So what are we going to do today, sir? We are going to move forward from section number 61 onwards. Section number 61 talks about the authorized share capital, power of the limited company to alter its share capital. There are four questions on this. Alter share capital. Sir, alter share capital, here basically they are talking about authorized share capital. How do I change my authorized share capital? Number one, sir, it should be authorized by the AOA. The power should be given in the AOA, and based on that, I will alter my MOA. Why, sir? Because authorized share capital is mentioned in the MOA, and I'll have to pass an ordinary resolution. I'll have to pass an ordinary resolution in the general meeting. So basically, I can do such alteration by passing an ordinary resolution if it is authorized by AOA. Okay. What is alteration of authorized share capital, sir? When you talk about alteration, there are five things. I will make you remember it the way I did make you remember in the class. There are five things about alteration of authorized share capital: increase, consolidate and divide, consolidate and divide, convert, subdivide, and cancel. What did I say, sir? Increase the authorized share capital, consolidate and divide it into shares of smaller amount. Consolidate and divide it into shares of larger amount. Sorry, consolidate and divide into shares of larger amount. Convert it into stock and reconvert it into shares. Convert into stock and then reconvert into shares of any denomination. Subdivide shares into shares of smaller amount, and then cancel. Cancel any paid up share capital. Cancel any shares which has not been taken up, and diminish the amount of its share capital by the shares so cancelled. Diminish the amount of share capital by the shares so cancelled. So these are the five things that I wanted to talk about. So number one, increase the authorized share capital. Please remember along with me, this is revision. You just have to keep by-hearting, keep repeating and keep revising. Sir, increase the share capital, increase the authorized share capital. Those who are my class student, for these sections, you always refer to the notes that we made in the class. It will give you more comfort. Okay. After that, sir, consolidate and divide it into shares of larger amount. Convert it into stock and reconvert it into shares of any denomination. Subdivide into shares of smaller amount than it is fixed by the memorandum. After that, cancel any shares which has not been taken up and diminish the amount of its share capital by the shares so cancelled. But sir, this last point is important. The last point includes 2 points. Cancel the shares which has not been taken up, diminish the amount of the shares. However, please make sure such cancellation shall not be deemed to be reduction of share capital. It will not be considered as a reduction of share capital. You will not consider it to be a reduction of share capital. Are you with me? Guys, are you with me? Yes, sir. Are you with me? Rishikesh, is it live or premium? It is a live session, Raja. It is a live session. Okay. All right. Okay, perfect, sir. So moving to the next part, sir. What is section number 61 is done? Section number 61 is done. After that, we immediately study section number 66. What is section number 66? So section number 66 talks about reduction in share capital. And open the notes that we made in the class, sir, because that will give you more comfort. And for those who don't have it, you write down looking at my screen if you want to. But sir, The notes that we made in the class, these are the notes that we made in the class. Let's come to reduction of share capital. Sir, reduction of share capital. Listen to me very carefully. Sir, when I say reduction of share capital, what is reduction? Sir, reduction of share capital basically means that you reduce the liability on the shares which is not paid up. The shares which are not paid up, you reduce the liability. Number two, you cancel any paid up share capital which is lost or not represented by available asset. Or number three, you pay off any paid up share capital which is in excess of the want of the company. These are the three cases where reduction of share capital happens. Sir, in section number 61, we were talking about alteration. Here we are talking about in 66, we are talking about reduction. That is, there is only one thing will happen. It will reduce. It will not increase. Number two, sir, in section number 61, we were talking about authorized share capital. Here we are not necessarily talking about authorized share capital. We could be talking about something else also. Now listen to me very carefully. Sir, reduction can happen for three reasons. Number one, reduce any liability on shares which is not paid up. I'll give you example for each of them, sir. So for example, I had issued shares of rupees 10, which was out of which rupees 8 was paid up and rupees 2 was not paid up. So I said rupees 2 I am waiving off. Waiving off as in I said, you don't have to pay 2 rupees. So when you do that, what happens? Your share capital reduces, sir. It was 10 rupees earlier, now it is 8 rupees. So there is a reduction of liability on shares which is not paid up. That 2 rupees is reduced. Number two. Sir, in that example only, rupees 10 was paid up. Rupees 10 was not fully paid up, it was partly paid up. Now rupees 8 will become fully paid up shares because 2 rupees you are waiving off. Number two, sir, cancel any paid up share capital which is lost or unrepresented by available asset. Sir, I gave you example in class. Listen to me very carefully. Sir, if for example, I invested 10 lakh rupees in a company. Okay, I invested 10 lakh rupees in a company. That 10 lakh rupees is showing as paid up share capital of 10 lakh rupees. Okay. Against that, I purchased asset of 10 lakh rupees. Okay. Is it fine? Yes, sir. Now I kept on facing losses and my assets came down to 4 lakh rupees. And here I'm showing a loss of 6 lakh rupees and I'm showing paid up share capital of 4 lakh rupees. We said, no, 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 no. Don't show paid up share capital of 10 lakh rupees. Your paid up share capital is not 10 lakh rupees because it is not represented by available asset. If you are saying that you have given 10 lakh rupees to the company, where is that 10 lakh rupees? You have lost it. So if it is lost or not represented by available asset, you will reduce your share capital. You'll reduce your share capital. This is the second case, which is cancellation of any paid up share capital which is lost or unrepresented by available asset. Or pay off any paid up share capital which is in excess of the wants of the company. For example, you took 10 rupees from each shareholder. Now you just want 7 rupees. You don't want the excess 3 rupees. You will repay this excess and that will reduce your share capital. So either you reduce liability by on the shares which is not paid up or cancel or excess that you have, you refund them. In that case, it leads to reduction. I have given you example for each one of them, sir. Now, what is the procedure for reduction? It is very simple, sir. Number one, you will pass a special resolution. Shareholders' approval is must. You will have to alter your memorandum of association. Why, sir? I'll tell you why. Guys, sometimes when you reduce your paid up share capital, your authorized share capital will also change. Why, sir? Sir, if I had 1 lakh shares of 10 rupees each, okay, now I am reducing it to 1 lakh shares of rupees 8 each. So what will be the face value of each share? 8 rupees. So I have to change my authorized share capital also. It was 10 lakh shares of 10 rupees each. That also has to become 8 rupees each. So because of that, I'll have to alter my memorandum of association also. So the concept that you have to understand is on reduction of share capital, authorized share capital also gets altered. Number three, approval of tribunal is must. Look at the process. Company will go to the tribunal and say, allow us to reduce the share capital. Allow us to take the risk. What is risk? Reduction in share capital. Tribunal will send a notice to central government, ROC, creditors, and SEBI, if it is a listed company, saying that this company wants to reduce share capital. These people will have to give their representation within 3 months. They'll have to give their representation within 3 months. Now, if the tribunal is satisfied, the tribunal will have to satisfy himself. Satisfy about what, sir? What are you saying? Array, satisfy about what? That the claim of the creditors is discharged, that the creditors are not at risk, and their consent is obtained, and that the accounting treatment is as per section 133. That proper accounting will be done for this reduction in share capital. Sir, how do you know proper accounting will be done? Sir, it will be said by the company. It will be told by the company's auditor by giving a certificate. So if the tribunal is satisfied about two things, that creditors are okay and accounting treatment is okay, then it will give an order and you'll file that order with ROC, and that is when reduction in share capital happens. That is when your reduction in share capital will be effective. So it is a very simple process, sir. Number one, SR. Number two, MOA alteration. And number three, approval of tribunal. Are you with me? Number three is approval of tribunal. So tribunal, you will send a notice. Tribunal will inform to four people: central government, ROC, creditors, and SEBI. They have to give representation within 3 months. Now, after that, if tribunal is satisfied that creditors are okay, their claim will be discharged or they have given their consent. And accounting treatment will be as per accounting standard. Who will tell you that, sir? Company's auditor. Then the tribunal will give it order and a copy will be sent to ROC, and that is how reduction will actually happen. Are you with me? Are you with me? Are you with me? Guys, yes or no? Yes or no? Yes, sir. Sir, this is your section number 66, which talks about reduction of share capital. Now let's move to the next bigger section, sir. Section number 62. What is section number 62? We will read it from the notes because we have made pretty good notes. You can also use my summary book. The flow would be the same. You can also use ICA module. The flow would be the same. But 61 is done, 66 is done. Now coming to the next section, which is 62, which is further issue of share capital. Guys, revise along with me. In this case, the company is going to issue share capital under three scenarios: where you are issuing right issue, where you are giving it to employees under ESOPs, or where you are giving to any person for consideration. Sir, if you look at both these scenarios, all the three scenarios, at least you are getting some money. In right shares, you are getting some discounted but price, but you'll get some money. In ESOPs, you are getting some money. In consideration, also, you're getting something at least. But sir, after this, we will read section number 63, which is about bonus shares, where you are not getting any money. Where you are not getting any money, it is free of cost. So first, let's talk about right issue, guys. Listen to me very carefully. This is a very big section. Right issue says that company, if they want to issue right issue, they'll have to give a notice to the existing shareholder. In that notice, they'll give an offer to purchase the shares. That shareholder, you can purchase the shares of the company in proportion to the paid up share capital. How will you send this notice, sir? Registered post, speed post, courier, or any other electronic mode. And you should have proof of delivery that we have actually sent you the notice. Sir, how much time will you give? Sir, your offer will open, and at least 3 days before the opening of the offer, you will have to inform them. At least 3 days before opening of the offer. And then once the offer opens, within 15 days, you will have to, minimum 15 days, you will have to, listen to me very carefully. Once the offer opens, it has to be open for minimum 15 days and maximum 30 days. Sir, but the minimum 15 days and maximum 30 days, this minimum 15 days can be reduced in case of a private company where consent of 90% has been obtained. If 90% shareholders are saying, Array, you don't have to keep 15 days also, keep it 7 days, then you can keep a minimum number of 7 days also. But maximum will be 30 days. This cannot be extended beyond 30 days. So basically, sir, imagine you are a shareholder. I'm the company. I'll send you a notice. I'll say you have the offer, you have the right to purchase the right shares. Then I'll send you via registered post, speed post, and these things. And then I'll open it for minimum 15 days, maximum 30 days. And if you want, if you're a private company, you can reduce 15 days to less than to up to 7 days. You can reduce this. But maximum limit, listen to me very carefully. You're not paying attention. This maximum 30 cannot be increased. In exam, they'll ask you. Then they increase by 90% consent. No, sir, maximum 30 days cannot be increased. After that, guys, what can the shareholder do? Either the shareholder will go ahead and purchase, or the shareholder has the option to renounce. Renounce as in he can transfer his rights to someone else. He can transfer his rights to someone else, or he can just ignore. Sir, if there is no reply from the shareholder, it will be deemed to be rejected that they don't want the shares. And in that case, board shall dispose such shares in a manner non-disadvantageous to the company or shareholder. Now it is on the board. The board will dispose such shares in a manner that is non-disadvantageous. So what is the opposite of advantageous? Disadvantageous. What is the opposite of disadvantageous? Non-disadvantageous. So basically they are saying in a manner which is advantageous to the company or shareholder, in a manner that should be advantageous to the company or the shareholder. Are you listening to me? Yes, sir. This is your right issue. This is your right issue, which is very important. Please understand, for right issue, no one is asking you to pass a special resolution or ordinary resolution. There is no requirement as such of passing ordinary resolution or special resolution. If you go to ICI module, they have written that some resolution is required, but if you go and read the Pair Act, there is no requirement of any resolution. In module, they have just randomly written, but there is no resolution required for a right issue. Okay, guys. If you want to take the shares, you take it. If you don't want to take it, you don't take it. Okay, no one is forcing you. Okay, okay, sir. After that, coming to the next portion, which is ESOPs. ESOPs. Sir, what is ESOP? Listen to me very carefully, guys. What is ESOP? ESOP is employee stock option plan. You must have studied about ESOPs a little bit in your in your accounts also. Sir, in ESOPs, there are some things that you have to understand. Sir, an employee is said that today, that is the date of grant of ESOPs, so the share price is 1,000 rupees. Tomorrow the share price may go up to 5,000 rupees, but 3 years later, that is called as vesting period. After vesting period, you will have an option to purchase the shares for just 500 rupees. This 500 rupees will be called as exercise price. Granting, vesting period, date of vesting, and exercise price. And after that, you will have a lock-in, and lock-in maybe of 1 year. This could be the arrangement, right? This is called as ESOPs. In such ESOPs, you have to first pass a special resolution and then you have to comply with the rules. In ESOPs, you first have to pass a special resolution. Special resolution is a must. Now, listen to me very carefully, guys. Please, 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 please. Sir, SR is required and rules. But sir, first understand ESOPs are given to employees. Now, who are employees of the company, sir? Sir, you had already studied the definition of employees in the last lecture, wherein we discussed section number 54, which was sweat equity share. So in 54 sweat equity shares, you discuss the provision of ESOPs. Now listen to me very carefully. Sir, you will have to pass a special resolution. Who will pass and who are employees of the company, sir? Sir, listen to me very carefully. Employees means permanent employees of the company in India or outside India. Directors of the company, whether full-time or part-time, or any other employee or director of the holding company or subsidiary company. Sir, this is the same definition that we studied in the sweat equity share also. But here there are some differences in section number 62, which is about ESOP. It says that in director, you will exclude independent directors. Please do not count independent directors. You have to exclude independent directors. Independent directors can never get ESOPs. And moreover, in the definition of employees, you will exclude two people. Number one, promoter or person belonging to the promoter group. So promoter as in the founder of the company, or the people belonging to the founder group, or any directors who hold more than 10% of equity share. So if you're already holding so much of share, you cannot get ESOPs. So promoter cannot get ESOPs, director cannot get ESOPs if they hold more than 10%. But sir, this exception that we have, this exception is not applicable for a startup in the first 10 years. If you are a startup company and in the first 10 years, even if you're a promoter or even if you're a director, you can get the ESOPs. So basically, sir, ESOPs can be given to these people, but ESOPs can never be given to independent director. And ESOPs can also not be given to promoter or director holding more than 10%. But however, if you're a startup company in the first 10 years, you can give ESOPs to promoter or director. But however, Raja, listen to me very carefully, Raja. Sir, even if you are a startup in the first 10 years, you can still not give ESOPs to independent directors. Independent directors can never, ever, never, ever, never, ever, never get what? ESOPs. Are you with me? Are you with me? Are you with me? Yes, sir. Sir, will you provide? Aditya is asking, will you provide revision of all the chapters? Yes, Aditya. But for that to happen, you have to show me some love. Only if these videos are helpful for you. Only if you go to the comment section and let me know how much this video is helping you. Only if you show some likes in the video. I see, yes, boss, people are engaging. Only then I'll be motivated to provide such detailed free revision lectures. But for that, you have to reciprocate some love. The thing that I'm asking in return is your appreciation is my motivation. We'll keep a very, very aggressive target of this video, sir. We'll keep a like target of, let's say, in over a period of 2-3 months, 200 likes I want in this video. If you help me achieve that kind of likes, and that is when I'll provide you more and more content that will help you. Okay, Raja. Okay, sir. All right. Perfect, guys. Now listen to me very carefully, guys. What is rules of the ESOPs? Sir, some rules, please understand. For ESOPs, you have to pass a special resolution. Number two, sir, you have some freedom. You can decide the exercise price, you can decide the lock-in, and you can decide the vesting period. But vesting period has to be minimum 1 year at least. So you can decide the exercise price. You can decide the lock-in period. We have not even said 1 year, 2 year, no. For sweat equity share, we said a fixed lock-in period of 3 years. But here there is no lock-in period limitation. You decide. Number three, sir, when you get the when the ESOPs are granted, see, today is the day of grant, and after 3 years it will vest. So today, when the ESOPs are granted, you will not get any voting rights or dividends on that. Once you exercise the options, as in once you get the shares, that is when you get the voting rights and dividend. Until then, there is no voting rights or dividend. And more importantly, the options that you have, sir, it is not an asset. You cannot transfer it. You cannot pledge or hypothecate it. You cannot do anything with that option. It is basically useless the time you exercise such option. Okay. Now, sir, what will happen if in case if the employee dies? In case if three, there were the vesting period was 3 years. Okay. Now before that, if the employee dies, sir, in that case, it will vest immediately in the hands of legal representative. That is, the legal representative can immediately opt to purchase the shares. But if there is a permanent incapacity, it will again vest immediately, but in the hands of the employee himself and not in the hands of legal representative. In the hands of the employee himself, because he's alive now. But if he retires or if he resigns, if he's removed or if he resigns, then the option will lapse. Then the option will lapse. He will not get any benefit out of this. Sir, are you listening to me? What am I saying? I'm talking about your ESOPs. In ESOPs, if the employee dies, it will vest immediately in the hands of the legal representative. If there is a permanent incapacity, it will vest immediately in the hands of the in the hands of the employee. But if there is a removal of resignation, the option will expire, the option will lapse. There is nothing that you can do about that option. Okay. After that, sir, point number C is very important. We are reading section 62(1)(c). 62(1)(c). It talks about offer to any person. As in, for example, if I am a company, sir, my company is, let's say, SS Limited, for example. Now, guys, listen to me very carefully. If I took money, hello, if I took money from, sorry, if I took a building from a builder, if I took a building from a builder and in return I gave him the shares of my company. So here, sir, am I getting any consideration? Yes, sir. Is that consideration in cash? No, sir. It is in kind. Consideration in kind, as in I'm getting some property. So in this case also, you are issuing shares for consideration. If you are issuing like this, you fall in this category and you will have to comply with three conditions. Number one, pass a special resolution. Special resolution is mandatory. For right issue, sir, there is no SR or OR. But for ESOPs, SR is required. For other issue, SR is required. Apart from that, there has to be consideration, sir. It can be in cash, it can be in kind. That's okay. But there has to be a consideration mandatory. And number three, valuation will be done by a registered valuer. As in, whatever property I'm getting, what is the valuation of that property? It will be done by a registered valuer. It will be done by a registered valuer. Are you getting my point? Are you getting my point? Yes, sir. These are the three conditions that you have to satisfy when you make offer to any other person. In the question bank, sir, 1 second, let me tell you. Go and solve question number 19 of my question bank. You will feel that how important it is. Question number 19 was about section number 61 versus 66. If you are able to understand question number 91, it is completely doable for you. And these sections that I'm teaching you has utmost importance in your exam, sir. Utmost importance. Okay. So guys, keep listening to me very carefully. Please listen to me very carefully. Sir, this is your offer to any other person. Okay. After that, guys, sir, what about conversion of debt issued to the government? Hello. What about conversion of debt issued to the government? Hello. Sir, listen to me very carefully. Sir, what about conversion of debentures issued to the government? Guys, please listen to me very carefully. Sir, there is a provision that if the government has given you some sort of loan or the government has given you some sort of debenture and you are a company, sir, the government can force you to convert this loan or debenture into shares. Why would the government do it, sir? If it government thinks that it is in public interest, government can force you to complete. Sir, to convert. Even if such conversion was not written in the agreement, but still they can force you to convert because it is in public interest. Now, sir, listen to me very carefully. In practical life, government has done this to Vodafone company. For Vodafone Limited, whatever loan they had given, they have converted it into shares. Okay, so where any loan or debt is obtained from the government may, in public interest, order for the conversion into shares. They can order that please convert into shares, even if the loan agreement does not have such option. Even if it was not written in loan agreement, still the law is giving you power to do it. Now, if the company is aggrieved, sir, they are giving this order. They are giving this order. Company is not okay with the order. So company will within 60 days of such order inform the tribunal. Company will inform the tribunal. Company will inform the tribunal within 60 days that guys, please look at this thing. Government is forcing us to convert and the terms are not good. But sir, how will government decide the terms? How will government decide the terms? Sir, the government will consider the financial position of the company, the terms and conditions of the issue, and the rate of the interest. What are the three things? The financial position of the company, the terms and conditions of the issue, and the rate of interest. After considering these three things, the government will convert themselves in the debentures into the shares. Sir, this is basically a forced conversion. Listen to me very carefully. Sir, government can force you to convert the loan and debenture into equity shares, saying that it is in public interest to do so. If you are not okay with such decision, you can make an application to the tribunal within 60 days. But how will government order that, sir? Government will consider the financial position of the company, the terms and conditions of the issue, and what was the rate of interest. And based on that, government will give you an order. Now, listen to me very carefully. Sir, there will be two things that will happen automatically. Two things that will happen automatically when the government converts what the government converts. Guys, 1 second. तो बैठेगा यार कहाँ बैठेगा मेरे को एक बार सर थोड़ा एक सेकेंड एक सेकेंड गाइस just give me a minute, so sorry, just 1 second, एक मिनट रुक जा guys. Please understand that one thing. Sorry to break the flow, but listen to me very carefully. Sir, when the government or when the government orders the conversion as in your loan will be converted into equity. Your loan will be converted into equity. In that case, there will be two things that will happen automatically. Number one, the authorized share capital will increase by the value of the shares issued. That is, your authorized share capital will automatically increase. And number two, your MOA stands altered. That is the memorandum of association that you have, it will stand altered. That is, your memorandum of association will change and your authorized share capital will automatically increase. How much increase, sir? By the value of the share issue. So, for example, if the Vodafone Idea company issued 1 lakh shares to the central government, then in that case, your authorized share capital will increase by 1 lakh. Okay. Now give me 1 minute. 1 minute. You revise this and then we'll move forward. I think that ends your section number 62. Revise this, then we'll move forward. Sorry, guys. Hi, sorry. Okay. So I said that this was your section number 62. Now we will move on to the next section, which is your section number 63, which talks about bonus shares. Very simple, sir. Whenever you talk about bonus shares, there are six conditions that you have to take care of. If you're issuing bonus shares, sir, in accounts, what do we call it? Bonus is nothing but capitalization of reserves. In accounts, we say bonus is nothing but your capitalization of reserves. If you want to, what is capitalization of reserves, sir? Basically, you transfer the balance from reserves to equity share capital. So if you are doing this, you will have to comply with six conditions. Number one, sir, AOA should authorize the same. It should be authorized by AOA. Number two, bonus has to be recommended by the board and approved by the shareholders. Sir, just like dividend, it will be recommended by the board and approved by shareholders. Number three, you have not defaulted in your deposits or debentures. There are no defaults with respect to deposits, debentures. Only then you can go and give bonus shares. There is no default with regard to statutory dues of employees. There is no default with that of statutory dues of employees. The same point was there in section number 43 DVR. And partly paid up shares have been made fully paid up. First of all, you will make fully paid up shares, and then bonus once declared cannot be withdrawn. Once you announce the bonus, once you declare the bonus, you cannot withdraw it. So if you look at these six conditions, once these six conditions are satisfied, only then you can issue the bonus share. Sir, AOA, recommended by the board, approved by the shareholder, not defaulted in deposits or debentures, no default of statutory dues of employees, and partly paid up shares have been made fully paid up, and bonus once declared cannot be withdrawn. This is mandatory, sir. Because what happens once you declare the bonus, the share price goes up. Now, if you are withdrawing it, then you are misusing this news. You are misusing this news, so basically you cannot withdraw it. But sir, I said bonus is nothing but capitalization of reserves. But remember that you cannot capitalize revaluation reserves. Revaluation reserves is the most useless thing, useful for nothing. So you cannot capitalize your revaluation reserves, cannot be used to issue bonus shares. Are you with me? Guys, are you with me? Did you understand? So that was your section number 63, which talks about bonus shares. Guys, now, after that, section number 64. Section number 64 is a very simple section, sir. It says, it's been so long that you have not connected with the ROC. You should send a notice to ROC. When, sir? In case if there is an alteration of authorized share capital under section 61. Sir, do you have to remember the section number 100%? Yes, sir. 100% yes, you have to remember the section number. Sir, so alteration of authorized share capital under section 61. Or if there is increase in authorized share capital under section 62. Sir, when did authorized share capital increase in section 62? I'll tell you. You remember government had given you debt. Do you remember that was converted into equity? And do you remember because of that your authorized share capital stands increased and your MOA stands altered? Do you remember that? Yes, sir. Sir, that is where your authorized share capital increases. You have to inform to ROC. And number three, where there is a redemption of preference share, you have to give a notice to ROC in 30 days in Form SH7. So basically, section number 64 is something which is linked to 61, 62, and 55. That if there is an increase in alteration of authorized share capital or increase in authorized share capital under 62 or redemption of preference shares, in that case, you will give to notice to ROC within in the form SH7. In the form SH7. Okay, guys, did you understand? Did you understand? Pakka, did you understand? Yes. Okay, guys. Now listen to me very carefully, sir. This is your point number 67. This is your point number 64. Now let's move to the next section, which is your section number 68. 60, sir, now what is done? 61 is, what did we do? 61. 61 is your authorized share capital. Alteration of authorized share capital. 66 is reduction of share capital. 62 is further issue of share capital. 63 is bonus. 64 is what? 64 is notice under section 61, 62 or 55. What is left, sir? I can say that what is left, sir, 67 is left and 68 onwards is left. Sir, what is section number 61? Let's read section number 61 from the notes. Sir, section number 67 talks about restriction on purchase by company or giving loans by it for purchase of shares. Restriction on purchase by company or giving of loans by it for purchase of shares. What is the meaning, sir? It means that section number 67 says that you cannot give money to your, and the question on this section was asked in your January 25 attempt, sir, for very good marks. This section was asked in your January 25 attempt for very good marks. Listen to me very carefully. It says that, sir, it basically, the basic rule is no company shall give loan guarantee or security or any financial assistance for purchase or subscription of shares of the company or its holding company. No company shall give any loan guarantee or provide security or financial assistance for purchase or subscription of shares of the company or its holding company. Okay. So basically, no public company can give these things for this company. But however, you cannot give money for purchase of your own shares. But sir, there are three exceptions. Exception one, two, three. Exception number one, if the company is a banking company and the loan is an ordinary course of business, it is okay. Banking company, ordinary course of business, absolutely okay. Point number two. The provision, point number two, if you are giving it as per any scheme, if you are giving it as per any scheme, then that is also okay. And point number three, if the loan is to employees for purchase of shares of the company, this is the most important point, sir. Sir, if a company is giving loans to its employees, yeah, better. Sound कम कर ले. Yeah. If the loan is given to the employees, loans are given to the employees of the share employee. If the loan is given by a company to the employees and not to big employees, other than directors or key managerial person, for an amount not exceeding 6 months of salary or wages, with a view to enable them to purchase the fully paid up share of the company or the holding company, it is all right. बैठो नीचे बैठो बैठ जाओ ठीक So guys, basically, so sorry about the disturbance, doesn't usually happen. Sir, I said that if you are giving loan, if the loan is given by a company to its employees, so basically what is the exception? A company can give loan to its employees. And we say, when we say employees, we don't count key managerial person, we are not saying directors. We are saying to small employees. And if the amount is less than their salary of 6 months, their salary of 6 months, and they are going to purchase fully paid up shares of whom? Of the company or the holding company, then we are okay. Look at so many conditions, sir. Usually, I cannot give the money to the employee saying buy my own company shares. But here there is a small exception. Employees other than key managerial person or director, amount less than equal to 6 months of salary, fully paid up shares they have to purchase of the company or the holding company, then it is absolutely all right. This is the point, sir. However, they will have to give the disclosure in respect of voting rights not exercised by the employees in respect of such scheme. Not an important thing. But did you understand this portion? This is very important, sir. This is your section number 67, which talks about restriction on purchase of shares by the company. Restriction on purchase by company or giving loan for it to purchase the shares. You cannot give loan to the employees. You cannot give loan to the employees. Are you with me? Okay. Okay. Now, guys, let's move to the next section, which is your buyback. Buyback of shares. Please listen to me very carefully. What is buyback of shares? Guys, what is buyback of shares? What is buyback of shares? Buyback is basically, listen to me very carefully. Sir, buyback means, how will you do the buyback? I'll make you read from the notes. It is very interesting. You read from the notes. Sir, buyback is purchase of your own shares. Buyback is purchase of your own shares. Okay. There is a lot of disturbance today, but I'm sorry about that. But never mind. I'll still give you a quality revision for buyback. With undivided attention, let's focus on buyback. So section number 68 talks about buyback. Buyback. Sorry. Guys, buyback. Buyback talks about source of buyback. What will be the source of buyback? The source will be free reserve, securities, premium account, or proceeds of fresh issue. What will be the source of buyback? It can be free reserves, it can be securities premium account, or it can be proceeds of fresh issue also. These are three places from which we can do buyback. Free reserves, security premium account, or proceeds of the fresh issue. But however, listen to me very carefully. If you're using free reserves or securities premium account, then in that case, the buyback, you will have to create a CRR. You'll have to create a CRR, that is capital redemption reserve. You'll have to create a CRR, and that will be only used for the bonus shares. How much CRR will you create? Up to the nominal value of the shares. But however, what are the three sources, sir? Free reserves can be used, securities premium account can be used. Remember section 52, 5 usage of your securities premium account. The last one was buyback. Okay. And last one is proceeds of fresh issue. But always remember, no buyback can be made out of proceeds of earlier issue of the same kind. As in, if I am issuing an equity share, using that money I cannot buy back the older equity shares. That is not allowed. You have to make fresh issue of different kind of capital. Okay, so proceeds of earlier issue of same kind cannot be used for the buyback. Now, what is the condition for buyback, sir? Sir, there are again 6 conditions that you have to remember. Number 1, it has to be authorized by the AOA to do the buyback. Number 2, you have to pass a special resolution. Number 3, sir, please listen to me. Special resolution will not be required if the buyback is of less than equal to 10% of the paid up equity share capital plus free reserves. If the buyback is up to 10% of paid up equity share capital plus free reserves and board resolution has been passed, then SR will not be required. Board resolution will be enough. Up to what limit, sir? 10% of paid up equity share capital plus free reserves. But beyond that, you will have to take an SR. Number 3, sir, what will be the maximum amount of buyback? The maximum amount of buyback will be 25% of paid up share capital plus free reserves. 25% of paid up share capital plus free reserves will be the maximum amount of buyback. With approval or without approval, maximum 25%. But in case of the buyback is of equity share, what will be the limit? It will be 25% of paid up equity share capital. You'll not add free reserves, sir. There are 3 limits that we just studied, sir. Limit number 1. First of all, it has to be authorized by AOA. Then you have to pass SR. But SR will not be required. Board resolution will be enough if the buyback is up to 10% of paid up equity share capital plus free reserves. Point number 3, what will be the maximum buyback in a year? Sir, in a year, the maximum buyback will be 25% of paid up equity share capital plus free reserves. Paid up share capital plus free reserves. That will be the maximum amount of buyback. But if you are buying back equity, it will be 25% of paid up equity share capital. It will be 25% of paid up equity share capital. After that, guys, point number 4, secured plus unsecured debenture upon paid up share capital plus free reserves will be less than equal to 2. Secured plus unsecured debenture upon paid up share capital plus free reserve should be less than equal to 2. That is, your debt equity ratio should be less than equal to 2. And only fully paid up shares can be bought back. And if you're a listed company, comply with SEBI. Unlisted company, comply with rules. So there are these 6 conditions that you have to satisfy: AOA, SR, no SR, maximum limit of buyback. Number 4, debt equity ratio should be less than equal to 2. Fully paid up shares can be bought back, and you have to comply with the rules. But please listen to me very carefully. Once your buyback is done, buyback shall not be made within 1 year from the closure of preceding buyback. If you have just finished your buyback, you cannot, for at least 12 months, you cannot do another buyback. After 1 year, you can do a fresh buyback. Now, guys, when you're doing a buyback, you have to pass a special resolution. For that, you have to send notice of the meeting. In that, you will attach explanatory statement. In that, you will tell them about the facts. What are the facts, sir? You'll tell them the material facts of the buyback. What kind of buyback are we doing? What is the amount that you're going to invest? Which class of shares are you buying back? And the time limit for completion of this buyback. What will be the time limit for this completion of buyback? Sir, the date you pass the relevant resolution, you have to complete the buyback within 1 year. So 2 time limits, sir. When you pass board resolution or SR, sometimes SR is needed, sometimes SR is not needed. But whenever you pass that resolution, within 1 year, you have to complete the buyback. And after that 1 year later, you cannot make a fresh buyback. Okay. Sir, one very important point, you will have to give a declaration of solvency. Company will give a declaration of solvency to the ROC and SEBI if it is a listed company. It means that if you're an unlisted company, even an unlisted company, buyback can happen. And in that case, you will inform only to ROC. Sir, you will give a declaration of solvency in the form SH9. It is an important form number, sir. Now, what about SH9, sir? Please listen to me very carefully. Sir, this declaration of solvency has to be signed by 2 directors, out of which one has to be managing director. 2 directors, out of which one has to be managing director. In that, they will give an affidavit. By affidavit, they will write that we have made full inquiry into the affairs of the company and we think that the company is capable of meeting all the liabilities and the company shall not be rendered insolvent in the next 1 year. that the company is capable of meeting all the liabilities and company will not be rendered insolvent in the next 1 year. This is what you'll write in the declaration of solvency, that we have made full inquiry. You don't have to worry about it. The company will not be rendered insolvent in the next 1 year, and the company will be able to meet all its liability. If these two conditions are satisfied, then you'll give declaration of solvency to the ROC, and if you're a listed company, to SEBI also. Okay. After that, what will happen, sir? Sir, once the buyback is done, whatever share certificate you have received, those will be destroyed. Or if it is in demat account, your shares will be extinguished within 7 days of the buyback. Within 7 days of the buyback, you will do this thing. And after buyback, listen to me, for at least next 6 months, at least next 6 months. Sir, see, when I'm doing buyback, no, I'm showing that I'm very rich. Give me back my shares and take back your money. But again, after you just completed a buyback, within 6 months, do not go and issue any fresh shares of same kind. Same kind shares cannot be issued. Fresh issue cannot be done of the same kind. But however, if you want to give bonus shares, sweat equity shares, ESOPs, these things you can do. It is not a problem because these are old commitments. Bonus, you're not getting any money. Sweat equity share is necessary for business. ESOP is old commitment, so it's okay. But right issue again, right issue you cannot do. Right issue cannot be done. Right issue cannot be done. And to give it a closure, please read the timelines. Read the timelines very carefully, guys. Board resolution or special resolution, whenever you pass, within 1 year, you have to complete the buyback. After that completion, within 7 days, you have to destroy the share certificates. Within 6 months, you cannot make a fresh issue of same kinds. And up till 1 year, you cannot do one more buyback. These are the time limits that we studied in this chapter. These are the time limits that we studied in your section number 68, which talks about your buyback. Are you clear? Is it clear for you guys? Yes or no? Is it clear? Yes. Perfect. All right, guys. This is your section number 68, which talks about buyback. What is section number 69? Sir, section number 69 says a very small thing. It says that, guys, your source is free reserves and security premium account. If you use free reserves or security premium account, you will have to create a CRR of the nominal value, and that CRR can only be used for bonus shares. It is written in where? It is written in section number 69. Are you with me? Yes, sir. After that, coming to section number 70, not a very important provision. But what is 70, sir? 70 talks about prohibition on buyback. Sir, directly, if you are doing buyback, we are okay with it. But indirectly, don't try to be very oversmart. Oversmart as in, no company shall purchase its own share via your subsidiary company or investment company. You don't go to your subsidiary company and don't ask them to purchase your holding company shares. No, sir. Don't do buyback indirectly. Or don't give money to investment company to purchase your own shares. No, sir. This is indirect purchase. You cannot do it. And moreover, if you have defaulted in deposit, debenture, preference share, dividend, term loan, if you have defaulted, then you cannot buy back for 3 years from the date of default is made good. So first you rectify your default, and after that 3 years you cannot buy back, and after that you can go for buyback. So basically, indirectly via your subsidiary company or investment company, you are prohibited to do buyback. And if you're defaulted in these things, you cannot buy back for up to 3 years. Are you with me? Yes or no, sir? Tell me yes or no. Sir, this is your prohibition on buyback. But the most important section is section number 68. If you look at this, there are so many questions that have been asked, sir. In my question bank, I have merged the different similar questions. But after merging also, there are 7 to 8 questions that have been asked from this particular section, and it is going to only increase. Okay. Did you understand? Did you understand? Yes or no? Sure. Okay. Okay, guys. Now, guys. Sir, section number 68 is done. Section number 68 is done. 69 is done. 70 is done. And we come to the last section of this whole chapter. After this, your chapter will be done. We come to the last section of this whole chapter, after which your chapter will be done. Sir, what is the last section of this chapter? I'll make you understand from the charts that I have made. I'll make you understand this last section from the charts that we have made. Listen to me very carefully, sir. Sir, one second. Sir, one second. It will get cleaned up. Yeah. Okay. Sir, this is a chart that I have made for the debentures. You can make this chart yourself also by looking at the, when I'm teaching, you will understand that it is very easy, but you have to just remember along with me. Okay, guys. Sir, first of all, debenture. What is the definition of debenture? What is the definition of debenture? Hello. Sir, what is the definition of debenture? So the definition of debenture is that debenture includes debenture stocks, debenture bonds, or any other instrument evidencing debt. Debenture trust, debenture stock, debenture bonds, or any other instrument evidencing debt, but it does not include instrument in Chapter 3 of the RBI Act, that is derivatives. Not a very important definition, sir, but you can understand from the definition that debenture includes bonds also. So whenever you say bond, section number 71, which is a debenture, will apply. After that, what are the basics, sir? Please understand that debentures can be convertible debentures also, non-convertible debentures also. And sir, listen to me very carefully. When you are issuing convertible debentures, you have to pass special resolution. When you are issuing convertible debentures, listen to me very carefully. Debentures can be convertible debentures also or non-convertible debentures also. If it is convertible debentures, you have to pass special resolution. But if it is not convertible debentures, what will you do, sir? Hold your thoughts. If it is a non-convertible debenture, that is, that is not going to convert, then you will have to wait. But understand that debenture holders do not have any voting rights. They do not get any voting rights. After that, sir. So can there be secured debenture? Yes, sir. Always understand there can be secured debenture, there can be secured deposit also. Sir, what is the tenure of the debenture? Sir, the tenure is usually 10 years, less than 10 years. For preference shares, it was 20 years. It is 10 years. This can go up to 30 years also in case of infrastructure companies. In case of infrastructure companies, it can go up to 30 years also. Infrastructure company, infrastructure finance company, infrastructure debt fund, anything related to infrastructure, it can go up to 30 years. Now, sir, how will you create a secured debenture? Sir, for secured debenture, you have to create a charge on the property or asset of the company, associate, subsidiary, or holding. You will give, you will create a charge on your property or asset of the company, associate, subsidiary, holding. What will be the value of the charge, sir? Sir, the value should be enough to cover principal plus interest. If you have taken a debenture of 100 crore and the interest is going to be 10 crore, your value should be enough to give you your security should be enough to give you a value of 110 crore. Only then it will be considered as secured debenture. After that, sir, for debenture, you will appoint a debenture trustee. When will you appoint debenture trustee? Sir, before prospectus, very early stage. Even before you get the money, before prospectus, you will appoint the debenture trustee. Who will appoint, sir? Sir, the company will appoint debenture trustee, not the debenture holder, the companies. And then it will enter into a debenture trust deed within 60 days of allotment of debenture. So basically, this is the prospectus. Before prospectus, you will appoint a debenture trustee. After that, you will open the issue, close the issue, and then you'll do the allotment. And after allotment, within 60 days, after allotment, within 60 days, you will do what? After allotment, within 60 days, you will do what? You will enter into a debenture trustee. Or, or says there is one more time limit. When the issue closes, after closure, within 90 days, or within 3 months, you can enter the debenture trustees within 60 days of the allotment or within 3 months of the closure. Guys, try to understand. See, this is revision. Please try to understand. Debenture itself takes one class in our exam oriented class. Okay, so please try to understand that either within 60 days of allotment or within 3 months from the closure of the issue, you will have to do what? You will have to take care of these things. Are you with me? Yes, sir. After that, what did I say? Sir, you will create a charge on the movable or immovable property of the company, not a problem. This is how you will create charge. So, sir, when it comes to a secured deposit now, there are 4 points, debenture now. There are 4 points that you need to remember. You will create a charge on the assets of the company, associate, subsidiary holding. Number two, the value of this asset should be sufficient to provide for the principal and interest. Number three, you will have to appoint a debenture trustee before the prospectus and enter into a debenture trust deed, a debenture trust deed within 60 days of allotment or within 3 months of the closure of the issue. And number four, sir, the charge can be on the movable or immovable assets of the company. These are the 4 points that you need to remember when it comes to secured debenture. After that, sir, you have to talk about debenture trustee, appointment of debenture trustee. How will you appoint a debenture trustee? Sir, the appointment, the name will be stated in all the documents. You need a written consent. Without consent, you should not do anything. You need a written consent of the debenture trustee. You need what? You need a written consent of the debenture trustee. Are you with me, guys? Are you with me? Yes, sir. After that, I said who will be disqualified to become a debenture trustee. This is a little complicated, sir, but relatively easy. We will try to understand. Who cannot become debenture trustee? Sir, if a person beneficially holds the shares in the company, if he is a beneficial shareholder, not the registered owner, he is the beneficial owner, he cannot become. If he is a promoter, director, key managerial person, or employee of the cash company, associate, subsidiary holding, he is an employee, director, key managerial person, or promoter. Or if he is a relative, if he is a relative of these people, relative of promoter, director, key managerial person, then in that case also he will not become a debenture trustee. So basically, if you beneficially hold the shares, or you are an employee or promoter, you cannot become a debenture trustee or a relative of these people. We are talking about whom? Debenture trustees. We are talking about debenture trustee. After that, you should not be entitled to the money from the company. You should not be eligible to receive some money from the company, except for your remuneration. Remuneration you can get. Apart from that, you are not entitled to any money. Similarly, you are not indebted to anybody, company, associate, subsidiary holding, or subsidiary of holding. You are not indebted to anyone else. After that, sir, you have not furnished guarantee for the principal debts. As in, sir, listen to me very carefully. If Reliance has issued debentures to these people are debenture holder. They have given rupees 100 crore. Reliance found someone X Limited. X Limited gave guarantee that don't worry, if Reliance doesn't pay, I'll pay you the money. Now, can X Limited become a debenture trustee? No, sir. He's the one who has given the guarantee for this 100 crore. So the person who has given a guarantee is called as guarantor. He is the guarantor for the principal debt. What is the principal debt? This is the principal debt. If he is the guarantor himself, he cannot be trusted. He cannot become a debenture trustee. Debenture trustee has to be an independent position. That is why we are saying no to whom? We are saying no to everyone, sir. We are saying no to shareholders, employees, or promoters. You have to receive money, you have to give money, or you have given guarantee. Everyone is disqualified. And the last one, if you have any pecuniary relationship with the company, don't read more than this. If you have any pecuniary relation with the company, sir, what is pecuniary relation? We said pecuniary relation is if the amount exceeds lower of 2% of gross turnover of the company, total income of such debenture trustee, or 50 lakh rupees, whichever is lower. If you will find the lower, if the lower came, for example, 50 lakh, and if the pecuniary relation, as in monetary relation, exceeds 50 lakh, then you are disqualified. So basically, sir, you should not have any transaction with the company, any monetary relation with the company exceeding the lower of these amount. What is lower of these? 2% of the gross turnover, total income, or 50 lakhs, whichever is lower. Come read along with me. 2% of the gross turnover, total income, or 50 lakhs, whichever is lower. If it exceeds this amount, then it is pecuniary relationship. Sir, this is your debenture trustee. Did you understand, sir? These people cannot become debenture trustee. Sir, can you remove a debenture trustee? Yes, sir. Who can remove? The debenture holders themselves, who hold 3/4 in value, can remove the debenture trustee. In your class, I had asked you to make the difference between debenture trustee and deposit trustee. Remember, debenture trustee can be removed by the debenture holders, but deposit trustee in chapter number 5 can be removed by the board of directors themselves. But here they can be removed by the debenture holder. Can he resign, sir? Yes, sir. He can resign whenever he wants to. But if he resigns when there is a casual vacancy, it has to be filled by the board. In case of any casual vacancy, it has to be filled by the board. In case of resignation, sir, it has to be approved by majority of debenture holder. Sir, if the debenture trustee resigned, then you're bringing one new person, you will have to take approval of majority of debenture holders. Otherwise, you cannot fill this position. Okay. Are you with me? Sir, this is appointment of debenture trustee. All right. Perfect. Sure. Perfect. Okay. Now, guys, coming to the last 2 points. Meeting of debenture redemption reserve. Important points. So this is more related to accounts, but we study it in law. You have to create a debenture redemption reserve and you have to invest or deposit such sum. Sir, how much DRR will you create? Sir, DRR will be created out of profits for dividend. Basically, free reserves. Okay. You'll use free reserves to create DRR. And in case of what will be the amount of DRR? It will be the 10% of value outstanding debenture. On 31st March, you will say what is the outstanding debenture. Of that, you will take 10% and you will create DRR. What will be the use of DRR? It will only be used for redemption of preference of debentures. So DRR is 10% usually created out of free reserves, out of profit for dividend, and it can be used for redemption only. So this is nothing but pure accounting entry, sir. Nothing to do with money. It is pure accounting entry. But on the other hand, sir, you will have to invest or deposit some money. This is about money. Here you are moving some money, actual money, not just accounting, but also moving some money. How much, sir? Sir, it says on or before 30th April of each year, you have to invest 15% or more of the debenture maturing during the year ending 31st March of the next year. Sir, what did I say? Sir, you will have to stand in a previous year. Okay, in a year. Okay, in a financial year. So before on or before 30th April, let's say financial year 25-26. So before 30th April 2025, let me use a better pen. Yeah. So this is your previous year 25-26. Now on or before 30th April 2025, you will have to invest 15% of the amount maturing in the 31st March of next year. What is 31st March of next year? So this is current year. 31st March of next year will be 31st March 2027. What is the amount maturing in this year? So whatever the amount is maturing, 15% of that you will have to separate, keep separate. And that you will have to invest in safe deposits, like you do fixed deposits or central government securities or safe deposit. And then you will use it for redemption of debenture. That money will be used for redemption of debenture. Now, what will be the minimum balance after that, sir? The minimum balance will be 15% of the amount maturing in the current financial year. What about whatever amount is maturing in the current financial year, 15% of that you will keep as a minimum balance. What did I say? Sir, invest or deposit such sum on or before 30th April each year. Invest 15% of the amount of debenture maturing during the year ending on 31st March of the next year. Investment or deposit not to fall below 15% of the amount maturing on 31st March of that year. Of that year. Sir, I had given you an illustration in class. I hope that will help you. Where will you deposit this money, sir? In scheduled bank or central government section? If you want to write this down, you can write this down. I'll keep it very simple for you. Sir, for the year 25-26, on or before 30th of April of 25, you will invest how much? 15% of amount maturing in 26-27. Where will you use this money for? Use this money for redemption. And what will be the minimum balance that you will keep? 15% of amount maturing in 25-26. Whatever amount is maturing in previous year 25-26, 15% of that you will keep as your balance. Did you understand, guys? Did you understand? Yes. So this is your debenture redemption reserve. If you note this down, I think it will be 100% clear. Okay. Now coming to the last point, sir. Sir, meeting of debenture holder. When will you call for? Who will call for the meeting of debenture holder, sir? The debenture trustee. On what scenario? If there is a request in writing by the debenture holder holding 1/10 of value. If there is a request in writing by debenture holder holding 1/10 in value. Sir, if debenture holder are asking for the meeting, you'll call for the meeting. Or if there is any event of breach or default, as per debenture trustee, which may affect the interest of debenture holder. If something wrong has happened in the company and debenture trustee thinks that we should call for a meeting of debenture holder, then he will call for the meeting. So either the debenture holder has requested at least 1/10 in value, or if there is a breach or default, he will call for the meeting of the debenture holder. Sir, it is a big section, but it is a very important section. I hope this concept is clear to you. Sir, where can you find this notes? I want you to find this note. I want you to write here itself. So when I'm zooming in, you can see this is the zoomed version. This is the version. You can keep writing on your own from here itself. You can look at the screen and you can write this in a A4 chart. And once you do that with your own hands, it will be very easy for you to revise on the day before exam. On the day before exam. Okay. Okay, guys, is that clear? All right, sir. So that's a very comprehensive and yet detailed revision of your share capital and debenture. Share capital and debentures. We have spent a good amount of time. We have spent approximately 2 hours revising this chapter in detail. I've showed you all the content, made sure that I cover each and every section in depth. Keep listening to this revision videos frequently, more and more. You keep listening to this audios and it'll stick in your head. All right. I hope this revision video were helpful for you. If yes, do show some love in the comment. Let me know how it was because your appreciation is my motivation. And now, whatever time is left for your exam, do make sure that you are giving your 100% because this attempt for you is going to be your golden attempt. And I'm sure that if you put a lot of hard work, you're going to get rewarded for each and every effort that you put. So do make sure that you're giving your best. And make sure that you like this video. I'll see you in the next video. Until then, take care, study well, keep going. This is your CA buddy Shubham Singhal signing off. Bye bye.